Welcome back to the Till. Today we're going to discuss 12 perfect steps from dream to doorsteps. That's right, the Till is truth in lending in life, and today we're going to break down the perfect home buying guide. And if you don't know anything about me, a few things that you should know. First and foremost, I'm a U.S. Marine, so I'm a veteran-owned business. I've been in business and the owner of First Meridian Mortgage. In October will be 30 years. Also, I'm also a licensed insurance agent, and I own KSA Insurance Agency, and I like to tell people I'm a boutique insurance company. Most of my clients are my mortgage clients, so they trust me to finance the house. They should probably trust me to make sure that it's insured properly also. The other thing, also a licensed realtor with Jobin Realty. So the insurance agency has been around for about 24 years, and I've been a licensed realtor for 20 plus years. So when you add all those up, I have over 70 plus years of experience in and around home ownership. I've also been ranked in the top 200 in the nation multiple times through Scotsman's Guide for volume, and that's pretty good considering it's me originating every one of those loans and my processor. My processor's been with me for 20 plus years. I've always ranked in the top 1% in the country, and I'm also a diamond agent realtor. When I talk about the perfect home buying guide, and I talked about trying to do things in a perfect manner, right? I started to think about what have I done that's perfect, that I'm most proud of, right? And one of the things is I have a perfect closing record on all my purchases in my career as a loan officer. So 30 plus years of never missing a closing date on a purchase. That record I'll put against most people. Next, in the Marine Corps, I did have a number of perfect PFTs, physical fitness tests, 18-minute mile, 3.1 minute miles, 100 sit-ups in 2 minutes, and 20 pull-ups, if I remember. Actually have a hole-in-one, and with the group I was playing with, I actually stroked on that hole. So technically, I had a 0. I don't know if that's a thing, but that's what it counted on the scorecard, and I made some money that day. And I also have multiple perfect bowling games. Still am missing the 800. And one thing that I'm probably most proud of here is the fact that I've been married for 37 plus years and I have 3 kids. With all of those things, I try to put in perspective that I'm trying to do things the best way I can in the most perfect manner that I can, right? So when it comes to today's journey, we're going to go through 12 homeownership steps designed for first-time home buyers and move-up buyers. And we're also going to take about 60 to 90 minutes to probably go through this, okay? So first and foremost, financial readiness. It's highly important that you understand your numbers. And there's 3 key numbers that you're going to need to understand. First of all is going to be credit. So when it comes to credit, 740 used to be the line, right? But as you can see, they've made things just a little bit harder for us, right? So the maximum that you can actually have is 850. So when a client calls me up and says, hey, Kevin, I got a 900 score on my credit card statement, and I say, that's a great score, but it's not an actual mortgage score because I know 850 is the max, right? And so what I try to tell people when you're looking at those statements, there are different credit score systems out there, different algorithms, right? So some of them are consumer, some of them are credit, card-based, some are insurance, some are mortgage, and then some are whatever that particular lender, they can call up Equifax and say, we want an algorithm with this data, and we want to have a score, and we want to be able to give it out to our clients. If they're willing to pay for it, CoreLogic, Equifax, all of them, they're going to give them a score, okay? So keep in mind, I use it as a guide. So if my score went up from last month, I'm probably doing the right things. If my score went down, I need to figure out what I did wrong, right? So here, 680 and above is still solid, right? Here and down below needs some work. Thing about it is, it's not that hard to raise yourself 20 points in a short period of time. You can get a free credit report and analyze that. You can take that free credit report, send it to a loan officer, talk to a loan officer about it, talk to a realtor about it that understands these things, and you could probably get some good tips that could raise your score. And by raising your score just 20 points, 40 points, 60 points, can dramatically save you on your interest rate, the amount of money you might have to put down, and also mortgage insurance. Most importantly, mortgage insurance. So let's get into the next set of numbers. Next set of numbers is debt to income, right? Need to understand what debt to income actually is. And I should have put this on two different slides, but we'll go through this and we'll make it work, right? So you have on debt to income, you have a front ratio and a back ratio. The front ratio is your housing cost. So if you own a home now, it would be what your PITI and your mortgage payment is, plus any HOA or condo dues. So it's the payment plus dues. That's your front ratio, right? And then your back ratio is all your housing plus your other debts. So your credit cards, your car payments, student loans, etc., right? So these both are added together, and then they're divided by your gross income. So we're going to show this a little bit differently here. So if your current rent payment is $4,000 and you make 10 grand a month, your front ratio is 40%. It's pretty simple. If you have $1,000 in car payments and credit card, 4,000 plus 1,000 is 5,000 total debt per month, divided by 10K equals a 50% back ratio, right? So total debts, gross divided by gross monthly income. Ideally, targeting under 43 is a good number. There are many people like Dave Ramsey. He wants this ratio to be under 28, and he wants to push that envelope even a little bit more, and he wants you to do a 15-year mortgage on that. That way you're debt-free before you go to retirement, okay? The next set of numbers, and we're going to go over debt to income ratio in one of those 12 steps. But this is knowing your numbers. and then also knowing what your future numbers are also. So next is savings, down payment, closing cost, and reserves, right? So one, you need to know what your down payment's going to be. You need to know what closing costs are going to be. And ideally, you want to have some reserves when you actually go to buy the house. I never want to take in these two items, take all your cash and you have no reserves. That's a no bueno. That's not good, right? So ideally, if this is an occurrence, maybe you need to get a seller credit, or maybe you need to buy less house, okay? I'm not afraid to tell people that they need to buy less house. So when it comes to affordability and reality checks, right? What can you afford? And what should you buy? Those are two different things. So you should consider your lifestyle that you currently have and the lifestyle that you're gonna have if you particularly buy a property. So if you stretch something to a 50 back ratio, are you going to be able to have the lifestyle you're used to or not? That's the question and the trade-offs that you may or may not have to do. So don't be house poor, leave room for emergencies. They always say you need 6 months. I believe that you need more than that if you can afford it and you can make it happen. After 6 months, you can start investing in other things, right? And for your future, right? And that's the main thing is you want to be able to invest accordingly, right? So don't be house poor. All right, so let's talk about credit and your financial reputation, right? So it matters when it comes to those credit scores. We talked about they were in 20-point increments, right? And how to potentially improve on those 20-point increments. We're going to go into a few of these things right now, right? So one of the things that you can do, payment history is important. Pay your bills on time. It's kind of self-explanatory, right? This is the big one, 30% of utilization. And what I mean by that is if you have a credit card limit of 10K, you should never roll more than 3K a month on that card. So utilization is key and it's powerful, right? Length of credit history. So if you take out a lot of new debt right before you buy something, then you don't have a history on that debt. And the thing that some people do when they make a mistake, a big mistake is when people get rid of the old accounts. They close those out. They take out a new credit card at 0% over here. Oh, I'm going to get 0% interest. And they roll from an old account over to that new account and they say, I'm going to kill this account. Well, if this account was 10K on the new one and 10K on the old one, and this one's maxed out, they're at 100%, and now you have a new card versus an old card. So if you do roll 10K over to there, it actually helps you having that second card because now you have 20K of utilization when you only had 10 before. Now you're at a 50 total utilization. Just don't close out that account. I personally do not close out any account that is free or under $100 annual. Also, new credit limits. Try not to have inquiries if you're going to go buy get a home. Try not to have any new inquiries. Inquiries drop off after 120 days, but you don't want to have 3 credit inquiries right before you go actually apply for a mortgage. Because what happens in our industry is they're going to ask you what each and every one of those were for. And if any new credit was obtained, and if they're in different industries, if one's a car, one's a mortgage, and one's for credit, they all count against you. But here's the thing. So if you're out shopping for mortgages, if you do have 3 credit pulls, sorry. So if you're shopping for a mortgage, let's say you're shopping 3 different places. As long as they're all within 30 days, they count as 1 credit pull when you're doing your mortgage, right? But as soon as you go past and it's 31 days, it now counts as 2. All right, so you want to keep your credit pulls tight, and you want to keep them to the same industry, okay? Next, quick credit wins, right? Things you can do if you know that you're going to be buying a house, right? So one of the things that you can do is you can pay those balances below that 30% limit. It's going to give you a nice pop on your credit score. You can become an authorized user on an established credit card. It does show history on yours. You can set up auto pay so you never miss payments. You can also set auto payment up on utility accounts, right? Utility accounts, right? But here's the thing. We'll see if I can fix that. Utilities, I don't know. You understand what I'm getting at, right? Utility accounts, but here's the thing. Don't forget to pay the Cox bill. If you set these accounts up and you say, oh, it's not a credit card, I'm okay if I'm late. If you subscribe to have your utilities tell the bureaus whether you're on time or late so you can improve your credit, it can actually hurt you. So I'm not a big fan of it unless you have no credit cards. You can check at annualcreditreports.com. Get a credit report, and then you can actually talk to a loan officer such as myself and actually go over some of those details and try to get some of those quick fixes, right? So next, let's talk about some mortgage options, right? So you need to kind of understand where you fit in the reality of, let's talk about the types of loans that you might qualify for. And in general, conventional loans, 3 to 5% down, 10, 15, 20, however much you can put down. Generally, you need a minimum of 620 credit score. To remember that number I gave you is 850 is the max, right? 780 is the upper limit. And here's the thing, right? As long as you get a automated approval, you are good to go, and you don't have to worry about manual underwriting. FHA, 3.5% down. Technically, they don't have a credit score right now, but if you're below 580, it goes to a manual underwrite versus a pre-approval, or the automated approval, right? The automated approval, you get that on either one of those, you're good to go. Same on VA. VA is 0 down, no MI, and you know, it is strictly for veterans. It is the best loan in the land. USDA is 0 down also, but it's only for rural, and they have income limits also. So you got to worry about income limits. One of the big things with FHA versus conventional, if you are putting those in a bracket, conventional, if you put less than 20% down, so less than 20%, right, you're going to have MI. There's a couple different variations of MI that you have, but also most people do borrower paid monthly. So you see that on your monthly statement, you know, might be $100, whatever the number is. And once you get to 78% of your original principal balance, it drops. Now you can get rid of it through some other measures, if you have 20% equity, you can petition to get it removed. There's a few other ways to get rid of the MI. But when I talk about this FHA, it does have a 1.75% upfront fee that gets added and financed on the loan, and then it also has monthly. So if you can go conventional, the MI is typically cheaper if you have good credit. If you have bad credit or need some work type of credit, then FHA might be the right option. VA does have a funding fee. First time use is 2.15, second time use is 3.3. They allow you to finance that. If you're exempt, it's 0, which was why that loan is the best loan in the land. Okay. So conventional versus FHA. I kind of went over that just a little bit just a few minutes ago. The MI does drop when it comes to the conventional at 78%. You can ask them if it's been 5 years or longer. You can petition to get rid of MI by doing an appraisal. And if it's under 5 years, if that appraisal comes in at 75%, then they'll drop the MI. So it depends, there's different rules. You have to ask them, how do I get rid of this mortgage insurance, right? Typically conventional is going to have a little bit lower cost. FHA, a little bit easier to qualify. They allow up to about a 55 back ratio, and a conventional is not going to allow over a 50 or 49.99. FHA is a little lower interest rate because it's government backed, but the MI upfront and the monthly MI could be more expensive than conventional. Just depends on your credit score. So there are some times that an FHA deal could be better for somebody versus going conventional, okay? So no two clients are the same. So VA versus USDA, they both were 100% down program, right? So fundamental differences, VA loans, you have to be a veteran, right? There's no MI. If you have a 10% disability, then you're exempt from the funding fee. Otherwise, it's 2.15 or 3.3 if it's a second time use, right? If you actually put down 5%, it drops to 1.5 funding fee on the VA. And if you put down 10, it drops to 1.25. Here's the thing. They allow you to finance that on top of the loan. So to make it easy for you, if you had a $100K loan, if you were at 2.5, it would be 102, 150 would be your amount. If you had the full, a second time use, you would finance 103, 300, right? And then likewise, if it was this one, it would be 101, 500 or 101, 250. That's what you would finance on this VA, but they allow you to pay for that and finance it. Thing about it is VA loan has lower rates. Has no MI. And what the VA also has is the ability to do a streamline refinance. And so whatever your original cost is when you're buying, you have the opportunity to lower that on a streamlined basis. The streamline is no appraisal, no financing, and lower cost. Essentially, they're done in like 2.5 weeks to save money, right? And most importantly, also, is the fact let's say this thing becomes a rental for some reason. You lived in it and it was your primary residence. This rental can still do a streamlined refinance when rates fall. So you're not stuck. The VA wants to take care of their veterans, okay? USDA is primarily for rural areas only, okay? And it has income limits, right? I specifically do not do these. There's just not a lot in our area. It's just not my forte. So I'm not gonna spend a lot of time on it, but most of the guidelines that you have on FHA are gonna be the same, okay? Now, let's talk about fixed rates versus adjustable rates. Now, I cut my teeth in this industry selling a monthly adjustable rate loan called a coffee, right? And it was a coffee loan with World Savings. Shout out to my mentor, Dave Stevens, Randy Kraut, Jennifer Duplessis, Lady Jennifer Duplessis. They taught me how to do ARMs very well. So fixed rate, same payment for life, predictable, and you can budget. One thing that a lot of Americans are realizing is, you know, a lot of people got 2 and 3 and 4% mortgages, but their payments are going up because of their home insurance rates and their taxes have increased. In some areas, the tax bill and the insurance bill might be 30% of their payment right now, but it's 30% of a lower number. So let's not get too sad for those individuals. So let's talk about adjustable rate mortgages. They have a lower interest rate. It adjusts after a fixed period of time. So if you can't explain how an ARM actually adjusts, you should never take one, plain and simple, right? So I'm going to try to give a quick class on an adjustable rate mortgage real fast, okay? First, it has an index plus a margin. Margin is the fixed money that the bank makes. They add that on top of the index to equal what I call FI, which is a fully indexed rate. Fully indexed rate, right? So hypothetically, if you're tied to a 1-year treasury bill, 1-year treasury bill, I'm going to make this really simple, and let's just say that is at 4%. 4%. Okay? So, and if your margin, and you need to know what your margin is 2.75, 2.75, and you also need to know what your caps are. Typically, most are 2 to 5 or 5 to 5. All right, so this first number here is crucial in understanding. This first number tells you how much it can go up or down when it adjusts the first year. Then this is what it is annual, and then this is what it is lifetime. All right, so I'm going to try to walk you through it just a little bit. So if you have a start rate at 5.5%, that's what you started at, and let's say we're doing a 5-1 ARM, and it has 2 to 5 caps. Okay, that's what we're doing. And our start rate is 5.5, right? So what happens is, think of it as a timeline. Year 2, year 3, year 4, 1, 2, 3, 4, and then year 5, something happens, right? So you got 1 year, 2 year, 3 year, 4 year, 5th year. In the 6th year, it's going to adjust, right? And you have to know your caps. Can it adjust 2% or 5%? So if it can adjust 2%, right? 2% is 7.5. If it can adjust 5%, it could go up or down 2%. It could go down to 3.5, right? So depending on where this index is plus margin, let's say the index now is at 6. So if the index, the 1-year treasury, is now at 6 plus 2.75, this person fully indexed rate is now 8.75, right? At 8.75, that is above the maximum. He would go from 5.5 to 7.5. All right, so that's where he would go in that scenario. All right, so he would stop at the 7.5 because of the 2% cap here. Now, after the very next year, right, because it adjusts every year after the first cap. So that this number, the 1, represents what happens after the first adjustment and how often it adjusts thereafter, okay? So same thing is going to happen here. If it stayed at 8.5, right, then in year 7, they would go to 8.75, even though the cap is 9.5. So they would go here at 8.75, right? They could go as high as 9.5, but the cap and the index rate is 8.75, so they would not go to the 9.5. So let's back it up just a little bit and go through year 6 again in a different scenario. Remember, index plus margin equals fully indexed rate, right? Let's say the index is now at 2%. Plus margin, 2.75, now equals 4.75, right? So let's go back and let's say he's got 525 caps. So if it's 525 caps, he could go as high as 10.5 and he could go down to 0.5 plus margin. Okay, so he could go as low as 3.25 or as high as 10.5. In this scenario, if he was at, and this is year 6, he would drop down to 4.75 for 1 more year, and then the whole scenario goes over and over. So that is a quick overview of an adjustable rate mortgage. Now, the thing about it is you need to understand your caps, need to understand your margin, need to understand your index, and you need to understand that in general, you could have a 2 to 5% change in that adjustment year. Now, government arms are typically 1.15, so they only adjust 1%. And you know, in some instances, you could, a 5-year might be, if you started low enough, might be good for 7 years at below 5% or below 6%, depending on the scenario. So adjustable rates are a little bit better on the Govy products right now than they are on conventional. Okay? Your power move is getting pre-approved. So getting pre-approved is essential when it comes to the home buying process. Whether you're a first-time home buyer, whether or not you're a move-up buyer, you need to understand, can I buy, if I'm a move-up buyer, can I buy non-contingent? Do I have to sell my house? What do I have to do to make this happen? And if I'm a first-time home buyer, I may not know anything. So it goes back to knowing your numbers, right? Knowing what those closing costs are, what your credit scores are, all of those things, what your debt-to-income ratios are, and you're gonna figure that out. Let's talk about pre-qualification versus pre-approval. First and foremost, this is one of my biggest pet peeves in our industry. And I can both talk as a lender and talk as a realtor because I have my real estate license. First and foremost, I always say that there's more truth in lending and dealing with a mortgage broker than a lender, credit union, or correspondent lender. The reason for that is we have to disclose how much we make, and we can't hide behind the fact that I work for a lender, okay? Every lender out there, every loan officer that writes a letter for a client, because you work for a funding institution, I'm going to say that again, because they work for a funding institution, the letter says pre-approval. It doesn't mean shit. Pardon the French. So what I want you to understand is there's more truth in lending with a mortgage broker because we have to write pre-qualified or pre-qualification unless it has been approved by a lender. So you have to read the letter that the loan officer at a bank, credit union, correspondent, you have to read the letter and see what it says. If you look at the footnotes from Wells Fargo, B of A, all the lenders, it will always say that it hasn't been underwritten. And there is always a variable in the letter. Most of the time, the loan officers don't even have access to the underwriting software, DU and LP. So how could they actually do the work? They don't, okay? Now, when I do a pre-qualification, my letter states that I've done full application. I fully verified the assets. I've checked the employment and verified the income. I've ran it through the DU or LP. I've gotten the approval through that. If it's a veteran, I get the COE, the certificate of eligibility. If they're hourly, I have to get a full verification of employment. Otherwise, I can't count the income because I don't know exactly how many average hours they worked over a 2-year period. If they're self-employed, I need 2 years tax returns. If they have any other businesses and or side hustle, I need potential business tax returns potentially. If they're a partner, I may need K-1s. I may need to do all of this before I give a pre-qualification. As I said earlier, I have never missed a closing date in 30 years when I've given a pre-qualification letter. I will have clients have agents will say, oh, can I get the pre-approval? Read the damn letter. Okay, and first and foremost, the next thing that should be done is this, right? So if your loan officer is worth any of his salt whatsoever, right? It doesn't matter if he's giving you this or giving you this, right? The most important thing is his reputation, that he calls and answers his phone. And what I mean by calls, you should have him call your listing agent to sell your deal. And that agent's gonna know, most of the time, I call before they've even reviewed your offer, right? And when I tell them that I haven't missed a deal in 30 years and that I'm the owner, all these things weigh a lot more than a loan officer that says pre-approval. Because of all of this. And that's why it matters. So I will put my pre-qualification letter against anyone's approval letter because they don't have this, and that's the track record. So let's get into what you need for that pre-approval and that pre-qual, right? So in general, I kind of just went over it. 30 days pay stubs, any additional income, side hustle, anything of that nature, you need to document what that is. Second jobs, had to have done it for 2 years for it to count. Otherwise, it just doesn't count, okay? 2 years, W-2s is the standard here. Whether or not I need K-1s, 1099s, last 2 years tax returns and business tax returns, right? And personal is going to depend on, do you have any side hustle, any K-1s, any other properties? If you are strictly W-2, then you won't end up needing the tax returns. But you need to disclose to your loan officer any of this other stuff because they're going to pull down a transcript from the IRS. And if they see it, then they're going to ask for those tax returns, right? Previous 2 months bank statements, all pages. On all of this, I can't stress that enough, all pages, right? Most recent 60 days worth of asset statements. So 401ks, IRAs, all of that stuff, especially any monies you plan on using for the down payment, make sure you're providing that. 2 forms of ID, employment and residence history for the last 2 years. When you do your application, if you don't have 2 years, make sure you fill that out appropriately, right? Likewise, for the employment, need that 2-year history, right? Make sure that you're giving us all that information. The other, if you have a house, doesn't matter if you're selling the house or not, we need the mortgage statement, the home insurance, and one of the hardest things here, I reiterate, HOA bill, a coupon. You cannot give me, oh, I paid my HOA bill on this bank statement. It doesn't work that way because we don't know if that payment that you made on that bank statement was for 1 month or 1 year. So there's no way to know what that monthly is because we have to count this into our ratios. Remember our debt to income ratios, right? So if you've been divorced, have a property settlement, special, and also if you're using any income from alimony, anything of that nature, we're going to need that. Orders if you're in the military or if you got a new job offer, right? There are times we close loans, someone might have a $160K job offer. They may allow you to close before you've ever started that job. Off of the offer as long as there's no contingencies. That's the key, right? But here's the thing. If in fact there's any contingencies or you've started that job, then it defaults to things like pay stubs and things of that nature, right? So you got to understand your timing can be crucial. HR contact information. Make sure we have that so we can know how to do the verification of employment. Now, there are times people should understand when it comes to getting pre-qualified and pre-approved, It's not a free process. It cost me $132 plus my time to do a pre-qualification. That credit report is getting more and more expensive, and it's not cheap. And I may start charging for it. People are gonna have to get used to that. HR contact information, make sure we have that. So these are things that we need to be able to give a pre-qual letter or pre-approval. Now, in many cases, I want to stress this to you right now. There have been many times someone has said, and I always ask as a quiz, is like, they're calling me, the shopping rates, hey, I've been pre-qualified elsewhere. I'll say, send me the documents that you sent them, right? And in many cases, they'll say, well, I got a pre-approval letter and I didn't send him any of those items. He did it without it. Now, let me stress and be clear. There are some systems out there that will download certain information and the system may take it and be able to give an approval. But in general, they didn't ask you for this. There's a high probability that they didn't do their job, right? And that it's not a true pre-approval, that they did verbal information. So if that loan officer doesn't have access to systems that actually pull down income and bank statements and everything, which is, which there are some systems out there, it's rare that the loan officer has access to it. So you need to ask them, I gave you this pre-approval, how did you do it without the documents? If he says, oh, I downloaded this, I downloaded that, and you're good to go, thumbs up, right? But if they didn't tell you that, I would question whether or not it's a pre-approval or not. So in our business, right, there are a lot of checks and balances that happen to us, right? We may give you a pre-approval, we send you out, and you may call us 1 month down the road, 2 months down the road, but we don't know what you did in the meantime. We gave you a lender letter. Maybe you don't talk to us for 2-3 weeks, and we don't know what you've done. So things that you should not do is don't change jobs, right? Don't go buy a car or apply for any other financing. Don't apply for credit cards. Don't make large unexplained deposits. If you're, one of the biggest pains in the butt we have right now is Venmo, right? Large payments, deposits coming into your bank account that have to get verified. You say, well, I already gave you bank statements. Why should that matter? What happens is, let's say the account that you wrote your earnest money deposit on for $5K, we have to verify that, right? And that's in this account, and we have, you know, $5,000 in Venmo. That's a problem. They're going to ask where that money came from. So do not change jobs. Do not get other financing. Do not take credit cards. Do not have large deposits without keeping the paperwork so that you can explain them, right? So that's kind of an overview of the items needed to get pre-qualified. So now you're pre-qualified, right? So let's budget for the total cost of the home, right? So in general, there are a lot of one-time costs, right? The down payment from 0 to 20%. You have a closing cost for the purchase. Up front, you have home inspections, right? Various different ones, appraisal fees. All of these two items are coming out of your, you know, this cash bucket that you have, right? And if you have, you know, 100K here, all right, and you start taking money away for these inspections, you have less money. So if your loan officer is giving you estimates without all these items on here, right, then it's not a very good accurate picture of your transaction. So I always go over a closing cost estimate as often as I can. Get a closing cost estimate that has all the fees to include the title company that you want to use. One of the biggest mistakes people make right here on closing cost, and I hate it when realtors do this because they're not always honest, is why are they choosing this settlement company that they're recommending? You as a consumer are going off of the realtor's advice most of the time, and who you might want to ask is actually who the lender would recommend, because he is the one that knows everybody's fees. You can go to every title company and usually electronically get a quote, right? And you should already have your settlement company picked out before you ever even are looking at homes, okay? Now, you have to be careful because there's this thing called MSAs, which is a marketing service agreements, that a lot of realtors are getting paid by recommending a set settlement company. Lenders could be getting paid too. If you think of Rocket, Close, the Redfin agents are getting paid there, and Rocket Mortgage are getting paid also to use Rocket Close. These MSAs are a big deal right now. So when you sign an agreement with an agent, you need to ask them who they are in bed with. Do they have any MSAs when they're recommending where my closing is going to take place? If they're recommending a lender, a settlement company, inspectors, who are they in bed with, right? So when you do your estimates with your lenders, and I highly recommend a mortgage broker and a lender, you want a full closing estimate. But I'm going to tell you the key is you tell them which title company you want to use. Give them the link. Provide them an estimate. You're going to be able to download these by going there at the title company and getting a quote, right? Provide this quote so that the estimates are the same, right? If Joe down the street is using our MBH and they're $1,000 more than me, it makes mine look better, and vice versa. So why not you use specific data when you're suggesting or asking them to actually give you a quote? So those are some big tips. So when it comes to that estimate, you're going to have your down payment, of course. All right? So you're going to have your down payment. All right? You're going to have your closing costs. You're going to have all this. Make sure you do not spend this prior to closing, okay? If your money is invested, liquidate it as soon as possible. Do not leave yourself stranded and short on cash, okay? All right, monthly costs, PIT, and more, right? So additionally, you have your mortgage payment, principal, interest, taxes, insurance, plus HOAs and potentially condo dues, right? Additional things, utility, maintenance, figure 1% annually, budget for that, right? I highly recommend before you go out looking for homes that you should be doing a budget. How much money you're going to have left over at the end of the month, right? Just in general, you should make sure that you understand your cost of living and how this purchase may affect that. A lot of people do not take into consideration the tax benefit of buying a house, right? So I think, don't hold me to this, I think the personal exemptions like 14K and maybe 31K if married, right? But right now, if mortgages are at 6% and someone is doing a $500,000 loan, that's 30K in interest plus taxes. So in theory, their taxes, they may end up getting more money back off of your taxes this coming year if you buy a house. Now, I highly recommend you buy earlier in the year, your months 1 through 4, so you get the whole tax year. And then keep in mind any points that you pay on a loan. If you pay any points, those are deductible also. But here's the thing. If you buy at the end of the year, months 8 through 12, and you pay some points, but you're not going to reach the interest deductible, you may be better off not to pay the points and then do a refi the next year early in the year. Okay, so just keep that in mind when it comes to some of those things. So we're going to get into a little bit of that budgeting I was talking about, right? So when you're budgeting, remember we talked about that the income ratios and rules, right? 2836 were the rules for the front and the back when I first got in this business, right? So in general, if you can stick to those rules, you're gonna have a very comfortable housing scenario, right? But here's the thing, as our incomes have increased, and depending on where you're at, the amount of disposable income on somebody that makes $200,000 versus somebody that makes $40,000 is a lot different, right? So someone that has 50% left over from 200 has 100K left over, right? If they had a 50 back ratio, right? If you have 50 back ratio on here, and that's divided by 12, right? And they had 40,000, that leaves 20 grand for the year divided by 12. So that's a lot different number, right? So in general, conventionals will allow up to about a 49.99 back ratio. There is no limit on FHA and VA, but it has to get that automated approval, right? Remember when I talked about DU and LP, Freddie Fannie buys products, as long as they have the approval, they're good to go. But if they don't have the approval, then they revert back to typically these 41 to 43 range. All right, so keep that in mind, right? So assembling your dream team is the most essential part of buying a home. It is a team sport. And first and foremost, you need to understand the players that you need on your team and why. First and foremost, the quarterback is your mortgage lender. He's going to be talking to all the agents involved. He's going to be talking to the title company. He's going to be potentially talking to home inspectors, radon inspectors, getting receipts. He's going to be talking to the consumer. He's going to be talking to everyone involved. Essentially, if you're getting a mortgage, is going to be talking to the quarterback, which is the mortgage lender. So he is your QB in this process. He's going to help you find the best loans, the best interest rates. Hopefully you're dealing with a mortgage broker. I personally have 30 different lenders that I evaluate on your behalf. If you're going to a lender or a credit union, they only might have one source for you, and it might not be the best deal for you in the area. You need to pay attention to that potential outcome. You need to know that this team player that is pre-approvals actually close on time. Also, if he does pre-qualifications, what's the difference, right? And he also should be able to make a phone call on your behalf to the listing agent to help you win your deal, right? So he needs to be a team player, but he's also coordinating the entire transaction if a mortgage is being done. You might also call him a head coach and also the owner of the team, in theory. Actually, I'll take that back. You're the owner of the team because you're hiring him, okay? So we'll leave it at that. You're the owner. Make sure you hire a good quarterback and a good head coach. How about that? You also need to hire a good offensive coordinator. He's going to be your real estate agent. That's your buyer's agent, right? So he's your offensive coordinator. He's going to help you find properties. He's going to help you negotiate. And he's also going to communicate throughout the transactions with you and guide you through and answer your questions, right? There's a lot of moving parts even after you've gotten under contract. Insurance agent, if you're getting a mortgage, right? You're getting a mortgage, you're going to need an insurance agent. So hopefully you're going to bundle that with your auto policy. Highly recommend that as an insurance agent. I would tell you make sure you try to bundle that. And try to get also an umbrella policy to cover the liability behind both your home and your auto. So you need to have some good conversations with that insurance agent. Even if you don't do that before the settlement, you need to coordinate that and actually have an insurance consultation either before or shortly thereafter. Okay? Title company, they're going to control all the money within the transaction. They're going to get it from the buyer. They're going to pay the seller. If anything else needs to be paid off, they're going to do that. They're going to make sure it gets recorded, all of those things. Costs do vary, and you also want to know who's recommending the title company, right? So I want to tell you something here that a lot of agents might be in bed with the title company. They're called MSAs, marketing service agreements. Some of these title companies will open up a small LLC, and this agent might get paid on some of the title insurance every time they close a transaction, especially if you go to a large team as your agent, because they're going to be trying to make money on that. Last but not least, home inspectors. They're like your defensive backs, right? And your linebackers, right? They're going to protect you from buying a house that you should not be buying. So they're going to evaluate and examine this property, make sure that not any red flags that you truly don't want to be caught necessarily buying a house that you don't want, right? So let's get into the home search. We're going to talk about the job of your realtor, right, briefly. So in general, your realtor should know kind of what your must-haves are. The musts and the nice to have, right? You list those: 2-bedroom, 3-bath, garage, whatever the case may be. They should know what these are, and they should also know what your nice to haves are also, right? It's very important that you communicate those with them early in the process. So hopefully you can get a home that you're going to love and be in for a very, very long time. Now, the other thing that you're going to want your realtor to do and yourself when you're looking at a home is you're going to be evaluating the condition of the home and the neighborhood, right? You're going to be looking at that from the standpoint of, can I see myself here? Do I see my kids playing on the street? All of those things evaluate how the neighbors are taking care of their homes. Is it nicely manicured? Is there an HOA? Isn't there an HOA? Is there a condo association due? Is there not? All of these things are very extremely pertinent. Next, I want you to drive to work from that house, right? Go to work from the house in the morning. So show up in the morning, go to work. Once you get off work, I want you to drive back home to that potential new house. This way you know if the commute's doable. Nothing's worse than buying a house and 3 months later you're extremely tired, and then you figure out why, that you bought a house that the commute was just too much, right? You also want to think about that commute from work. Where are the kids having their soccer games and their basketball games? Can you get there on time? Nothing's worse than missing your child make that free throw that just won the game, right? You want to make sure you get there, right? Proximity to amenities, right? Do I need to be in walking distance to the park, to a bike trail, to the bar, to a restaurant, to a grocery store, those type of things, or a pool, right? School ratings are something that I have mixed emotions on, right? Schools can be great today, but they could be bad tomorrow, right? The reality of it is it's the parents that are going to make that kid's education work, but the school is a part of that. But here's the thing, you get a new principal, might fire 4 of the great teachers that have been there for 30 years, bring in new blood, and your child is the one that gets all the new teachers. Therefore, your child has a 4 on a scale of 10 experience, and others had a 10, right? So I evaluate schools on a different basis. I want to know how the turnover of teachers actually are. When you walk into that home, right? I want you to be paying attention to the corners of the house, right? So when you walk into a room, and this is the room, I want you to come into this corner, that corner, this corner, and this corner, and I want you to look across the room and see if your sight lines all are level, right? I can stand in a kitchen and see if a countertop leans one direction or another, right? So you want to evaluate the foundation, cracks, the flooring. Are there 3 different types of hardwood in a house, things of that nature? You want to look at those things. Next, water stains, ceilings, windows. Are they new windows? Are the gas in between the panes, is it cloudy? Or do they need replaced? Basement, can you smell odor? It's got new carpet, new paint. Is that masking the odor? If they got new carpet, new paint, you need to look in corners. Look for mold, look for dark black spots. Ceilings, any repairs? Any repairs from the bathroom above? Where's the bathroom situated? Is there a small repair there and there's a bathroom right above it? Then you want to check out the plumbing in the bathroom. Again, we went over odors, fresh paint, covers up issues, right? Look for things that the seller may be hiding. Let's talk about, you've done all of that, you're happy, and now you want to make an offer and you want to win this house, right? What are the components of a strong offer when it comes to winning contracts? I write very few contracts. And I know what that sounds like is like, you're just not busy? No, I write perfectly good contracts and I win more often than I lose. The average client that I've represented in my career, I write 1 contract for. I probably only have to write 2 contracts once or twice a year. So in general, I want to walk you through some of the things I do when it comes to making strong offers. First and foremost, and this is important, your agent should give you a CMA on that home, a comprehensive market analysis. I also give a house canary report. If you want a house canary report on a house that you might want to buy, call me. I can do it across the nation. It's free, costs me nothing. I'll send it to you. Gives you some information that this CMA doesn't, right? Helps, right? But your offer should first and foremost be based on comps, and it should be based on a half-mile radius from the house that you're looking to buy. Plain and simple, it should show all the homes that have sold. And your mission, you have one simple mission, and that is to find 1 to 3 comps that are most like the house that you're buying, and what did they sell for? What was the list price? Was it plus or minus, and how many days on market? And then you can evaluate differences also, right? But the most important thing in this process is the comps. And that's where that running back or the agent comes into play. So you want to evaluate that market, and you want to know whether or not it's listed plus or minus where the market should have that house at. Next, earnest money. Earnest money you don't lose unless you're in breach of contract, right? So be strong if you want to be strong and you want to present that you're a strong buyer. So if you have $100K cash in the bank, give them a 10 or 20K earnest money. You're not going to lose it as long as you perform your side of the transaction, right? You get that money back if your loan gets denied. It all gets returned to you. No big deal, right? So strong on your earnest money. Contingencies, fewer the better. Financing, I hate it when people waive financing contingencies. I understand it. You need to understand from your loan officer's perspective what you're giving up, not what your agent wants you to give up. Your agent wants you to remove this. They say remove. I say keep. You have to be willing to decide one or the other and be happy with the outcome. You also have to know, most importantly, your risks. And your agent can only tell you some of the risks, not all the risks, right? So you need to have a conversation with both people in that side of the transaction. Inspections, fewer the better, but more security for you, right? So if you can get a home inspection, and we'll get into the different types, or a radon, all those things, it keeps you from buying a house that you don't want. I love losing $500 or $600 on a home inspection, because what I kept you from doing was wasting $500,000, okay? Appraisals, need to know when to waive appraisals, when not to, and how it may or may not affect financing when you do so, right? Inspections and timelines and closing dates. One, you should already have asked on your closing date if your loan officer has any problem meeting that date. And you should also understand your inspection periods, because those are your negotiation periods and potential to get out of the contract so you can get this earnest money back if you want to void the contract. Last but not least, components of a strong offer. And I cannot stress this one enough. Who you choose as your team members is going to matter when it comes to winning deals or not. Your loan officer should be willing to make a call to the listing agent and say, look, my name is Kevin Retcher. I'm the owner of First Meridian Mortgage. XYZ is my client. He's been fully approved. I have all of his loan documents. I have his W-2s, his pay stubs, his assets. I verified his employment. He's in the military. I got a COE. I have everything. You're not going to have a problem with closing. I personally have not missed a closing date in 30 years. It's an implicit guarantee that you're going to close on time and you're going to get your check, okay? If he won't make that call, then find a new loan officer. Secondly, I tell buyer's agents to CC me on the offer so I can make that call right when the contract goes over, so that agent, that listing agent, doesn't have to track down the quarterback, right? The quarterback's already scored, right? He's called for you. And that is really, really important. Let's talk about the 4 key contingencies when it comes to a mortgage and a transaction, right? Financing. This is the big one. Because remember, we just put up $20K for our earnest money. So let's talk about that, right? Financing protects you if the deal falls through. What could make a deal fall through? Maybe you lost your job recently. Maybe it doesn't appraise. Maybe you counted income that shouldn't be counted, things like that. So all of those things should never happen, right? If your team was put together properly, and I have 100% close rate, the financing shouldn't be a problem as long as it appraises, right? And you can comply with everything else within the transaction, in the contract. Home inspections gives you the right to negotiate repairs typically within 7 to 10 days, right? So most agents, if you send over a contract, oh, I want to do these in 10 days, they'll say, oh, I want you to do it in 8. I want you to do it in 6. I want you to do it in 4. The listing agent is trying to get you to get this contingency out of the way as fast as possible, right? You just want to make sure that you have the ability to do it. That's the key, right? So home inspections, we'll talk about those briefly. There are 2 types. One you can ask for repairs, and one that is like a void only or pass fail. The thing about it is, I've actually been able to ask for repairs and ask for money on void only sometimes because they don't want to go back on the market. So it depends how you play the game, right? So you need to understand these inspections, the timelines, and when they're due and when they're not. And your agent is responsible for making sure that those happen. Now, if your agent is one of those agents that have a transaction coordinator, stay on top of the coordinator. I personally have only met a few that actually stay on top of the timelines. And if you'll know whether or not they're on point on those, if they've sent you, hey, these are your timelines and I'm going to be communicating with you. But if you don't hear from a transaction coordinator on a regular basis, it's not doing its job, okay? Let's talk about the appraisal. The appraisal protects your financing, and if it doesn't appraise, you either can negotiate the price down, seller can bring that down, or you can pay the difference, or if you have financing options, you can walk away if you want. So in general, if it's a $500K purchase and it appraises at $490 and you waived all your rights, well, guess who gets to pay that extra 10 grand? You, right? But if you have your financing, you can say, Mr. Seller, I want you to drop my price down to $490. And if he says, sure, then you just saved 10 grand. Thank you, Mr. Appraiser, right? But if he says, no, you know, I really want, I'll split the difference with you. We'll go $495. So he loses 5, you lose 5, and everybody's usually happy, right? So that's kind of how that works. But again, if it comes in at $490 and you have your option, you can just say bye if you want, right? Unless the seller is willing to drop down to that, then you might want to talk and read your contract, okay? Next, first and foremost, condos. I'm going to say this right from the get-go. Never, ever waive your financing contingency if it's a condo. There are new rules out on condos right now, and the condo complex has to be approved by the lender to be able to get lending. And so it's like a whole secondary approval that's based upon it meeting guidelines for Fannie, Freddie, VA, FHA. Never ever remove your financing contingency or appraisal contingencies on a condo. You get 3 days to review these documents. You can just say, I don't like them. Here, I don't want the house. And you can walk away, right? It's the most powerful way to get out of a contract. Easiest. Don't have to give them anything other than, I don't want the house, right? You want to make sure that you're reviewing the budget. And this coming year, this is a pro tip. And if you don't listen to this and you're thinking about buying a condo, you're a fool, right? They just went from having a 10% reserve requirement to 15% in the next 6 months. Here's the thing. I don't know how they're going to raise that other 5% without having a special assessment or increasing your dues. So you're going to want to review these documents and talk to your lender about it. He actually understands a lot of these rules, maybe more than your agent in many cases. So these are your 4 main contingencies: financing, inspection, appraisal, condo. Your loan officer and your agent should be able to walk you through those, and you should have a good understanding of what those actually are. Market strategy does matter. Let's talk about that just a little bit. Buyer's market or a seller's market. So, buyer's market, you might be able to ask for repairs, have home inspections, negotiate a lower price than what the list is. Remember that CMA is going to tell you a lot of information on that. Do your homework before you make that offer, right? And then the seller's looking for, he wants above ask, limited or fewest contingencies, and quickest close. This one is a pet peeve of mine, the quick close. Let's just talk about that, right? I'll have buyer's agents say, oh, Kevin, I got to close fast, right? And they want a 15 or an 18-day close. And then when I call this agent, the listing agent, and they say, oh, 30 days is fine, I know the buyer's agent really didn't do his homework and or is just trying to make the sale go faster, or he's guessing or interpreting what is needed to win the contract, right? Above asking price, listing agents love to be able to say they sold the house for more. So if a house is sold for $349,900, if you come in at $350,000, he gets to say he sold it for more. Just a thought, right? I generally never end a contract or like to see a contract end on an even number. 525, go to 526. Or instead of 530, go to 531. You want to give a win if you want to win contracts. So you can be aggressive, but be smart. This is what I'm kind of leading into. Winning in multiple offer situations. First and foremost, the most important person here in this is the QB, which is the loan officer. You want to win in multiple offers? I help people win. And part of that is a solid pre-approval, and I generally do pre-qualification letters, and they're just, if not stronger, than pre-approval letters. Large earnest money deposits, fewer contingencies, But if you can keep that financing, keep that in there. Win by having a good loan officer. That's crucial. Quick close times, right? So here's the thing. I highly recommend 18 to 23 days as being fast, right? And normal speed 23 to 30 is no one's rushing the system. So 18 to 23. Now, if it's a VA loan, let me go over VA loans. VA appraisals, the appraiser is allowed 21 days if he so chooses to do a deal. So don't really go quicker than 23 days on a VA. Remember, your team matters. Communication and reputation, right? I can't tell you the number of deals I've won for people because those clients Googled First Meridian Mortgage's name and they saw that my name was in the top 200 in the nation multiple times as a loan officer. That my reputation as a number 1% top lender, top veteran loan officer in the Washingtonian magazine, it is just that powerful. I literally can show you right now, right here, Washingtonian, 2026, April, my name's in there as a loan officer. That reputation wins contracts, right? And the other thing about it is I've been in business for 30 years in this market. The fundamental chances are that I might have already done business with that agent before. And remember what I said, I've never missed a closing date in my life. So that agent can't say they didn't get paid when they did business with me. So reputation matters. And then give the other agent and client a win. That goes back to that 349.9. Give them 350. Give them the win. That helps you win in multiple offer situations. I promise. Home inspections and appraisals. Let's get into that. 2 critical checkpoints, right? So home inspections, in my opinion, you should try to make them non-negotiable in your contract if at all possible. Roof and age, check that. You want to check your foundation, check your heating and AC, plumbing, electrical, right? Windows, doors, insulation, average cost is about $400 to $700. My inspector spends 3 hours in that house. Now, listing agent might not love to hear that. Buyer's agents may or may not want to hear that, but that's the truth, right? And it takes that long to check every one of these things out. Now, if you have the right to ask for repairs, that is a full inspection, and absolutely, whenever you can do that, because for $400 to $750 might keep you from buying a house that you don't want that's $500,000, right? So definitely try to do that. Even if you can do what's called a walk and talk or a pre-inspection. Pre-inspection is probably about half the price. It's going to check some of those items, but it may only get by an hour and a half in that house. But it's a pre-inspection, and then maybe you can waive your financing. I mean, you waive your home inspection as a contingency to make your offer a little bit better, right? So after the inspection, depending on the type you have, you can request for repairs to be fixed. You can request credits toward closing. So key thing here is, let's say you had $8,000 worth of repairs that you were asking to be done. Instead, he wants to give you a credit. So you have $8K to be paid as a closing cost credit. Do not say 8K toward the repair of a roof. That would be bad. That's a no bueno, okay? We don't do that. You can also negotiate lower price if it's a significant issue, or maybe you already had some type of credit from employer or whatever the case may be, and you just wanted a lower price. And what, pro tip, you can never change the price that you paid for your eggs. Once you bought them, you got them. So the lower the price, the better. Even though you can finance a higher price, you pay over time, over 30 years. It's not as big of a deal, but a lower price is always the better option. Other option is walk away. Don't be afraid to say no. No is a perfectly good answer. It is a perfect answer if it's a perfect answer for you, right? Not for the agent, has nothing to do with them. They're not the one buying the house, right? Appraisal process. This one is huge, right? So you need to understand the appraisal process, and the QB needs to be able to educate you on that. So one, it confirms the value of the house for the lender, right? In some cases, if we use LP or DU, and those are the automated underwriting engines for Fannie and Freddie, right? It may give you the option to waive the actual appraisal. So what are the benefits? That's saying these guys, the big players, say that they are good on the value. So I personally should then be good on the value. The question is, do I want the number or do I want to save the $600? So here's the options. Let's say you have full appraisal and financing. If the price comes in low, purchase price is $500, we're going to say in this scenario, if it comes in low at $490, you can then renegotiate the price, right? If the seller says yes, you just save 10 grand. Seller says no, you have the option of paying the 10K difference and taking the loss yourself, or you can walk away. Those are all your options. So you can bring that extra 10K to the table and to cover the gap if you so chose. Or again, you can walk away. Now, here's the thing. If you have let's say you're putting 40% down. And let's say you negotiated a higher price on this house by $75K. You went in at $575 on this house. And LP says you can have a waiver. And you can save $600 by taking the waiver because it's good that this house was valued in LP and DU at $575. Would I take that waiver or would I have an appraisal done because I have the ability to negotiate a lower price? It's a tough call. If you're happy with the price, take the waiver. If you want to spend $600 to see if the appraiser can come in at that number, that's up to you. But generally, if LP or DU gives me a A-OK, I usually probably take the waiver in most cases. The closing disclosure. At the beginning of a loan, the lender is going to give you a disclosure called a loan estimate. As soon as you get that loan estimate, sign it. You're signing receipt, not accuracy. One of my fastest lenders, UWM, will underwrite the loan within 24 hours, and they use this loan estimate to complete a closing disclosure and it hasn't been compiled yet, but in general, they're sending it out because the government says you need to have one 3 days before settlement. And what it does is it checks that box. The government never said it had to be accurate. So they're using the numbers from the loan officer and the loan estimate to do the first, not final, CD. So things that you do want to look at it, final loan amount and rate, you want to check the lock date, that it meets your needs. You want to check the interest rate. You want to see if the monthly payment is what you're expecting and all the fees and the closing costs breakdown. Always sign them. You can ask questions later. Until you go to closing, none of this is final. That is most importantly to understand here. So let's talk about closing. Final walkthrough, check through. I want to make sure that all your negotiated repairs are complete. Your agent should have you sign that the house is in the condition that you said in the contract it was supposed to be at some point, right? That there's no new damage to the property. Appliance and fixtures are still there. Utilities are on and working in your name. Okay? I can't tell you the number of clients that forget to set up the utilities to be in their name, right? Now, here's the thing. Never, in my opinion, should you do this final walkthrough the night before or the day before. What happens if these pipes burst and you just have water? You did the inspection last night at 8 o'clock and everything's good, and now all this water is just raining down into your basement, right? This is your house, right? And you checked it yesterday, and now you have 4 inches of water in your basement simply because your realtor wanted to check it the night before. No, you go to the final walkthrough, check the house, and then you do your closing. Don't do it the day before, okay? That is a pet peeve of mine, as you can tell. Closing day, what to expect. So, a few things. Make sure that your money is in order, but make sure you know how to bring that money to the table, right? You should actually be checking 2 weeks before what the wiring instructions are, the cashier's check, and how to get a cashier's check, anything of that nature, and we should make sure that the insurance is in place, right? So first and foremost, one of the things that you should understand is if you don't get this money here, you're not gonna have it's not your house, right? The lender's got to get his wiring of his money there also, right? You're gonna sign a promissory note, deed of trust, closing disclosures, about 50 to 100 documents depending on the lender, right? And it can take anywhere from 60 to 90 minutes, or there are some instances where this is taking only 15 minutes because some of these documents are being signed before closing. So ask if you have the ability to sign the non-notarized required documents prior to settlement, right? So once you've done all of that, congratulations, you've got the keys, right? So this has been your 12 points to buying a home, and now you're the homeowner. So life after closing just is starting, right? So things that you need to think about in the first 30 days of owning this home, right? You're like, Kevin, I thought I'm done. I thought I was done with your seminar. Well, I got a couple more things to tell you, right? First and foremost, one of the most important things I'm going to tell you to do, oops, sorry. you thought you were done with the seminar, and there's still a few good tips to tell you. One, first and foremost, what I want you to do is I want you to change the locks. I know it sounds stupid, but I can't tell you the number of people that 3 years later still haven't changed their locks. Make sure your utilities are set up. Like if you had a rent back and you just took possession, make sure the utilities are in your name. Update all your addresses. Your W-2s, pay stubs, bank statements, your photo ID. Make sure you meet the neighbors. It doesn't hurt to hold a barbecue and invite a few. First 2 to 4 weeks, one, you want to set up your mortgage on auto pay, if you can. You also want to have your maintenance done on your HVAC if possible, and create a maintenance binder for all the receipts for everything that you do to this house the entire time that you buy it. Keeping those receipts allow you to raise the amount of money that you put into the home to offset taxes potentially later. Next, we're going to finish 3 ways to build equity and value in this home being a homeowner. One of the best ways to do that is to pay a little extra money to principal every single month if you can do that. Term is a function of what you pay to principal. So if you can add an extra $100 a month, time value of money, rule of 72, basically that money is going to double a couple times over the life of your loan, and you're going to save a lot of interest, right? Property appreciation over time is a real thing. My accountant says real estate doubles every 20 years, just depends which year you own it and if you're the lucky one, right? Do a no-cost refinance when rates are lower and use the savings to shorten your term. Here's the thing. There are many times I can save someone 3/8 in rate, 0.5% in rate for free, and if they're super smart, they continue to make this payment that they originally were going to make over 30 years. This was the 30-year time frame. I do a refi for them. They continue to pay this higher amount on this mortgage, and they pay this thing off faster, okay? So every time that you can do a no-cost refi, you just keep paying what you originally are comfortable paying, and you're just going to save all this extra money by having the loan pay it off sooner, okay? Budget 1% of your value a year for maintenance. A great tip that my sister does is she gets 3 to 4 weeks vacation a year, right? I highly recommend that the first week always be a house project. If you do that, the house will always be kept up and maintained, and then the next 2 to 3 weeks can all be fun, right? So you've budgeted your 1%, you do the home project, take the remainder of the money, and go have fun. It is a great tip. Next, insurance, right? So homeowners insurance, it's required, right? You should check that at least every 3 years and just see where you're at. Because what they have on home insurance is what's called an inflation guard. Typically they raise that 1 to 3% a year. So after 3 years, if there's not been any appreciation in the market, that might have increased by 10%, and you might be able to bring that down and actually save a little bit of money. Other key thing, protect your family, right? You just bought this new house, it's a 30-year mortgage. You should probably have a 30-year term life insurance policy on the breadwinner. Whoever was responsible for paying that mortgage, you should probably have enough money to pay the house off and replace their income so that the family can stay in that new home. an umbrella policy should have an umbrella policy that goes behind the home and behind the automobile that protects above those. And normally a $1 million policy typically costs anywhere from $400 to $600 a year. And that is going to be the umbrella over the auto and the home liability coverages. Flood insurance only when required, but if you're even near, you should absolutely do it.
Can you pause 2 seconds? So we can leave. All right, come on, buddy.
Oh, crap. Oh, this was a good run, so I don't want to.
There you go. That's not enough.
Yeah, no, we got. It's.
I got it.
I can get it back.
Hold on, Steve.
Just. So let's talk resources and ongoing support. So in general, your loan officer should be on speed dial. If you see that the 10-year treasury has dropped, you should give him a call and see if you can refinance with a no closing cost refinance, right? He should be on speed dial, right? You should tell him, if you can save me 3/8 at no cost, I want to be your first call. You tell him that, he's going to have you on speed dial. Annual reviews on your insurance. Ask your realtor for contractor referrals if you need to get something done. Market updates for the future. Do me a favor, if you're new to my channel, this is the till, which is truth in lending and in life. And I try to do a video every Tuesday. If you could like, share, and subscribe this, I would highly appreciate it. In closing, if you have any questions, my name is Kevin Retcher. I'm the owner of First Meridian Mortgage. A couple key things that you can do. Also, in your free time, is make sure that annually you check your credit report. You can go to freecreditreport.com. You can get an annual credit report there. Make sure you start a housing budget. And if you're looking to buy a home, schedule a pre-approval consultation via the calendar, or just give me a call. And I would be happy to make your homeownership's dreams come true. My name is Kevin Retcher. I'm the owner of First Meridian Mortgage. In closing, my name is Kevin Retcher, owner of First Meridian Mortgage. Hopefully you learned whether or not you're, in closing, hopefully you learned something about the home buying process and a perfect guide to home buying. So in general, if you have any questions, even if you're not in one of the states I represent, Virginia, Maryland, DC, give me a call. Shoot me an email. I'm happy to discuss home ownership with you. Talk to you soon. In closing, this has been your perfect guide to home ownership. My name is Kevin Retcher. I'm the proud owner of First Meridian Mortgage and KSA Insurance Agency. And I'm also a licensed realtor with Jobin Realty. So if you have any questions, feel free to reach out. If you're in Virginia, Maryland, or DC, I would love to help you with your home buying journey. If you're not, I do have loan officers in other states that I can recommend. So if you have any questions, reach out, DM me. I'll try to help you as best I can. Talk to you soon. Welcome from the till, which is truth in lending and in life. Talk to you. So thank you for spending your time with me. I much appreciate it. Remember, you can get started by checking your credit with the annual credit reports, starting your budget, getting pre-approved, and assembling your team. Let's make homeownership a dream, a reality. This has been your 12-step perfect guide to homeownership. My name is Kevin Retcher. I'm the proud founder of First Meridian Mortgage, a veteran-owned mortgage broker in Virginia, Maryland, D.C. Also a licensed independent insurance agency, KSA insurance agency in those states also, and also a licensed realtor with Jobin Realty. If there's anything that I can do to help you with home ownership, just let me know if you have a question. Even if you're in another state, I would be happy to help. Thank you for watching from all of us at the till. Truth in lending and in life. Talk to you soon.